Alright, the last stock we're talking about today, it's Intuitive Surgical. Now, this is a stock that is up after hours, was up bigger at one point after hours, reached the $700 limit today, or really the ceiling of $700. Stock overall is up right around 11% on the year. Nothing major, but from my perspective, I think that's a little bit high for the stock, right? To be up this year in a time in which really traditional surgery type companies. I mean, these companies that deliver medical devices are absolutely hurting like no one's business. The whole pandemic we're kind of going through right now is completely devastated a lot of the industry, as most hospitals have had to completely quarantine off half of their hospitals for this specific disease. So they're not able to do a lot of these procedures that they typically were because of the fact that they're dedicating resources to other things. So hospitals aren't buying really the equipment, and that's where Intuitive Surgical gets their money. It's from people buying the equipment. So overall, let's look at these earnings and see if that's quite accurate, what that looks like. I will say they beat pretty well as far as a non-GAAP perspective. Non-GAAP, they beat by 62 cents, but again, I talk about non-GAAP, and I typically use GAAP more because it actually gives a generalized approach to it for every single company, right? It's the same metrics that they look at. From a GAAP perspective, they missed by 14 cents and posted a 54 cents number. So it's a massive overall decline in EPS for sure, and it's not unexpected. Revenue declined 21%, but they beat by $215 million, which is a massive beat compared to estimates. Massive beat. So revenue was down big. And again, this is a stock that warrants a very high price target right now. Really just a very high PE ratio too. And to see declines of 22% in terms of revenue is not what you'd like to see. And it's kind of a shocker the stock's at where it's at right now, in my opinion. Overall, though, it is a very innovative company. There's no doubt about it. There were 178 Da Vinci systems shipped. Da Vinci being their really signature product, does a lot of things. I mean, this one machine does a lot of different procedures, so very big for them. But that was down 3% year over year versus a consensus of 141 only, so they mashed that, though. They mashed it. And I think that's why you see an overall rise in the stock. They beat on all aspects for the most part. Systems were down 20% in revenue, and services were down 26%. Obviously, all of that is entirely pandemic related. Quarter two earnings, as far as EPS was down 79% though, so you need to consider that. Net income down 78%. Still positive though, so you have to take that into account. It's definitely rough. Non-GAAP EPS was even down 66%, and that's not necessarily the main thing to think about. But as far as key future events, quarter four, launch of the extended use program, which it will introduce select 11 and 10 instruments with 12 to 18 uses compared to 10 of today. Prices of certain instruments used in lower acuity procedures will be reduced, lowering revenue per procedure but lowering customer cost. Okay. Again, they're going to take an EPS hit to try to build that customer base is what you're going to be really finding there. So definitely one thing to look at. So worldwide Da Vinci procedures decreased 19% compared to the second quarter of last year. Completely not unexpected, right? We kind of anticipate this because, again, a lot of these procedures have kind of been skipped over. Unless it's 100% essential, a lot of services, they're not doing them. Just being 100% honest with you. The company grew its Da Vinci surgical system installed base to 5,764 systems, an increase of 9% compared to 5,200 at the end of the second quarter. So you see where this company is going, and that's why really it's got the PE ratio that it does. You see growth here. The more systems they have in place, really, the more they get in terms of services revenue, and really the more they get in systems. But at some point, they won't be able to sell or really ship as many systems. They'll have to focus on service revenue. So you do need to think about that as well. there's not just an infinite number of hospitals looking for these very expensive devices. Not everyone can afford them, or multiple of them, really. So we talked about really quarterly income, revenue, everything like that. We saw that already for sure. So obviously, due to the impact, they mentioned healthcare system has been diverted really to focus on the current nightmare we're facing, right? It makes sense. So that doesn't shock me. I do want to look obviously at the balance sheet of this company and see what it has going for it. So overall, from a liabilities perspective, we're starting with assets. Stupid me. $10.1 billion in total current assets compared to 6 months ago of $9.7 billion. So good improvement there. But with that, you obviously see debt didn't raise. That's right. This is a company that did not raise their debt at all. $1.3 billion versus $1.4 billion of 6 months ago. So they rose their assets quite well, and they lowered their liabilities. So overall, stockholder equity did rise to $8.7 billion versus $8.2 billion. So I think it's a beautiful sign, and it's a beautiful balance sheet for this company. Beautiful balance sheet, and I don't think you can deny that. And my question comes to the valuation. I don't think I ever doubt the value this company has, right? What it can really amount to. But do you think it's worth the lifted valuation in the short term because of the fact that really they're going to be facing really just shortages for the next 2 quarters? They're likely going to be hampered down in terms of their business model. So is that warranted, the increased PE ratio? I'll let you decide that. For me, I don't personally think I'm ready to buy it at these levels. I'd much prefer it under 600, much prefer it anywhere under 600. I think it's just a little bit too high for me. The stock's risen it's just risen a bit too much. I mean, we're talking about since the lows in March, it's bounced back 78%. So I don't think it needed to bounce back that fast just due to the fact that, well, PE ratio is going to be falling. Business model is going to be completely hit for the next couple quarters. I mean, come on now. What do you expect? But if you're interested in this company, I see where it's going and I see the future that this company holds, and it's definitely a bright future. So I think that's why that PE ratio is where it's at and why the valuation is where it's at. But just you determine what you'd like for it. Personally, I'm not buying at these levels under 600, and you might call me a buyer, but not right now. I did hope you enjoyed.